Wait, let's unpack this. It is Tuesday afternoon, February 17th, 2026. It's 1 o'clock on the dot, Eastern Standard Time. And I have to be honest with you, right out of the gate, if you have been watching your screen since the bell this morning, you probably need a stiff drink.
Oh, yeah. Or at least a long walk around the block.
Just to remember that the sky hasn't actually fallen.
It has been a messy, messy morning. Volatile feels like a massive understatement.
Messy is putting it politely. You hear that morning flush right at the open, where it felt like the floor was just dropping out from under the indices.
Everything looks sick. Just a sea of red.
But now, here we are, early afternoon, and we're seeing this scrap, this like gritty fight back. The NASDAQ is still down a touch, maybe 0.25%. But the Dow is fighting its way back to flat, maybe even flashing a little green here and there.
But the numbers on the screen, they don't really capture the feeling out there today.
No, the vibe is strange.
It's distinct. It's what we've been calling AI anxiety.
Yeah.
It's this low-grade fever that's just simmering in the background of every single trade right now.
Yeah.
People are looking at these massive tech valuations, and they're getting nervous.
They're getting the sweats. But what's fascinating, and this is what we really need to dig into today, is that while people are anxious, the money isn't leaving the market.
No, it's not a dash to cash.
Right, it's not a cash out.
Yeah.
People aren't stuffing money under the mattress.
No, it's a rotation, a violent one.
And that is our thesis for today. The market is screaming a new message at us.
A completely different one.
For the last 2 years, the message was singular. It was buy the dream, buy the code, buy the AI wrapper.
Right. If it mentioned a neural net, you bought it. No questions asked.
If it was vaporware, we wanted it. We paid a huge premium for the idea of the future.
Exactly. But today, the message has flipped.
Yeah.
I mean, completely. The market is screaming, stop buying vaporware and start buying things you can actually touch.
We are seeing a massive rotation into what we're calling real assets.
Yep. Hard assets.
I'm talking about ships. I'm talking about medical hardware. I'm talking about geothermal power plants digging into the crust of the earth.
It is the revenge of the real world out there today.
It really is. And it's not just small moves either. We are seeing massive M&A activity, mergers, and acquisitions that confirms this thesis.
The big money is done playing with digital toys. They want to own the heavy infrastructure.
So here is the roadmap for this deep dive. We have a mountain of sources to get through, but we're going to break it down. We're going to start with this buying frenzy in the real world. Specifically, this massive shipping deal that has ZIM exploding. And what on earth is happening with Masimo?
Why these boring companies are suddenly the hottest things on Wall Street.
Exactly. Then we have to talk about the elephant in the room. The battleground. Amazon.
The $200 billion question.
Yes, Amazon started red. It's fighting back to green. We're going to look at the digital railroad argument, and we have a very specific tactical strategy for a listener who wrote in asking what to do with the stock right now.
And we can't ignore the wreckage in software.
No, we absolutely can't. Software stocks are down 24% over the last few months.
Brutal.
We're going to debate if that's a trap or if it's the sale of the century. And finally, we'll look ahead to tonight's earnings from Palo Alto Networks and the big one on Thursday, Walmart.
Sounds like a full slate. Let's do it.
It is. So let's dive right into the real world. I want to start with the headline deal that hit the tape this morning. Hapag-Lloyd is buying ZIM Integrated Shipping.
This is a huge deal. We're talking $4.2 billion.
And the market reaction was just instantaneous. ZIM shares are soaring.
You're parabolic.
Last I checked, they were up something like 28% intraday. But I want to pause here because for the average listener who isn't tracking container shipping rates or, the Baltic Dry Index every morning, why does this matter?
Right.
Why is a German giant buying an Israeli shipping line such a massive signal for the rest of us?
Okay, so to understand why this matters, you have to zoom out and look at the context of the shipping industry over the last, say, 5 years. Think back to 2021, 2022, the peak of the pandemic boom. Everyone was stuck at home ordering Pelotons and patio furniture and whatever else.
Right, and shipping rates went to the moon. I remember hearing it cost like $20,000 just to move one container from Shanghai to LA.
Exactly. These companies made money hand over fist. They were printing cash. But then came the hangover. Demand dropped off as the world opened up. Shipping rates they tumbled. And the industry, which is notoriously fragmented, started to look very, very distressed.
And ZIM was one of those companies people were really worried about, right?
They were at the top of the list. They had warned about weak conditions in the fourth quarter. Their balance sheet was looking heavy. Investors were worried they were going to burn through all their cash.
So ZIM was effectively on the discount rack.
Deep on the discount rack. So this is Hapag-Lloyd, one of the German giants,
Right.
walking into the store and buying the most distressed asset.
But it's more than just buying a cheap stock, isn't it?
Oh, it's so much more. This is classic industrial consolidation. In the shipping world, capacity is everything. When rates are low, the only way to win is to control the supply of ships. You want fewer players controlling more of the ocean.
So you can dictate pricing.
You can dictate pricing, you can stabilize the market.
Hold on, let me play devil's advocate here for a second. If the industry is so distressed, why spend $4.2 billion on old ships? Why not just wait? Or why not, build new, modern, eco-friendly ships?
That's the key question. And the answer is time and certainty.
Okay.
Building a new class of container ships takes years. You have to book the slot at the shipyard, usually in Korea or China. You have to wait for the steel, the construction, the sea trials. It's a 3 to 4 year lag. Easy.
And Hapag-Lloyd doesn't want to wait 3 years.
They want the capacity now. They want the muscle today. They are buying steel that is already floating. They are buying routes that are already established.
They're buying revenue? They're buying immediate revenue. Hapag-Lloyd isn't buying algorithm or some promise of future growth here. They are buying physical capacity to move goods around the planet. And the premium they are paying, that massive 28% jump in price, tells you that they believe the bottom is in for the physical economy.
That's the signal. They think we're done falling, the worst is over.
Right. They are placing a multi-billion-dollar bet that moving stuff is going to be incredibly valuable again and very soon.
And that ties into the broader theme, doesn't it? Because it's not just ships. Let's look at Masimo, ticker MASI. They are up massively today, something like 34%.
Yeah, and this is another fascinating story of real stuff versus, corporate distraction.
So Masimo, they make patient monitoring systems, right? The medical hardware.
Correct. Pulse oximeters. If you've ever been in a hospital and had that little clip put on your finger to measure your oxygen levels, that's Masimo.
Okay.
It is high-end, it's regulated, it's very difficult to replicate medical hardware. It literally saves lives.
But they had a bit of a weird moment a few years ago. Weird is being very generous. It was a full-blown identity crisis. Back in 2021, Masimo, this serious medical technology company, decided to buy Sound United for $1 billion.
Sound United. Wait, they make speakers, right? Like Bowers and Wilkins, Tinma.
Exactly. Consumer audio, high-end headphones, the stuff you buy at Best Buy.
That makes no sense at all. Why would a hospital equipment company buy a speaker company?
Well, the logic at the time, or the story they told, was that they wanted to pivot to consumer health wearables. They wanted to be like Apple.
Oh, boy.
The thinking was, we have the health tech, now we need the cool consumer vibe and the distribution.
Let me guess. The market hated it.
Hated it with a passion. The stock was down 50% over the last 5 years, largely because of that single move. Investors looked at it and said, what are you? Are you a hospital company or a headphone company? It was a total distraction. It was fluff.
So what changed today? Why the 34% rip?
Rumors that Danaher might be looking to acquire them.
Now, for those who don't know Danaher, paint the picture. Who are they?
Danaher is the apex predator of the industrial and medical world. They are a massive conglomerate, but they are incredibly disciplined. They are famous for the Danaher business system. It's all about efficiency, margins, and focusing on core technology.
And I'm guessing Danaher doesn't care about selling headphones.
Absolutely not. They could not care less. If Danaher is buying Masimo, they are buying it for the sensors, for the patents, for the hospital contracts.
They want the real stuff.
They want the real stuff. They are going to strip away the consumer fluff, probably sell off that audio business for parts, and focus entirely on the core medical technology.
So again, we see the smart money, in this case, Danaher, ignoring the corporate story, ignoring the pivot, and swooping in to buy the core physical technology that hospitals actually need.
It's a cleanup operation. And the market loves it. The market is valuing the stuff and completely discarding the noise.
And speaking of stuff and noise and power, we have to talk about Ormat Technologies, ticker ORA. They're up a solid 5 or 6% today. And this one connects the real world back to the tech giants in a way that I think is just so critical.
This is one of my favorite stories of the day because it highlights the bottleneck that nobody wants to talk about with AI.
Which is?
We talk about AI constantly, chips, software, models, But AI needs electricity, a staggering, mind-boggling amount of it.
And Ormat does geothermal, right? Digging for steam.
Correct. And the news today is that Google signed a major deal with them for geothermal energy.
So Google, the company that arguably organizes the world's information, the ultimate software and AI company, is writing massive checks for steam coming out of the ground.
They have to. Think about a data center. It's just a warehouse full of servers that get incredibly hot. And these new NVIDIA chips, they run hotter than anything we've ever seen before.
You can't run an AI model on hopes and dreams.
You need megawatts. You need raw power.
But wait, big tech always talks about being green. Wind and solar, why not just put a bunch of solar panels on the roof of the data center?
Because of the physics. It's a great question. Solar works when the sun shines. Wind works when the wind blows. It's intermittent. But a data center training and AI model needs to run 24 hours a day, 7 days a week, 365 days a year.
Nonstop.
You cannot have a power dip, not for a second. You need what we call baseload power.
Consistent, reliable, boring.
Exactly. Geothermal is baseload. You drill a hole in the earth. The heat is always there. The turbine always spins. So you have Google realizing that to win the AI war, to win the digital war, they have to secure physical power plants.
It's the infrastructure of reality.
That's a great way to put it. You can code the software, but you can't code the electricity. You have to go out and buy it. You have to build it.
So if we synthesize this first segment, we have ships, we have medical sensors, and we have steam power plants, all catching a major bid today.
While the story stocks that rely purely on, future growth multiples are struggling, the Bank of America Fund Manager survey that came out this morning highlights this perfectly.
What did it say?
It showed a massive rotation into small caps and real economy plays. Investors are looking for tangible value. They are tired of guessing.
Which brings us to the most tangible yet digital battleground of them all. The company that sits right at the intersection of real stuff and AI dream.
Amazon.
Amazon.
Ah, yes. The $200 billion gamble.
Let's look at the price action first. Amazon started the day in the red. It looked ugly. I think a lot of retail investors were holding their breath.
I'm sure they were.
But as we speak, it has fought its way back. It's trading around $201.18, up about 1.2% intraday.
It's showing some real resilience, but let's be honest, it's been a rough year for them compared to their peers.
Oh, yeah.
I mean, Amazon is down about 12% year to date. You compare that to Walmart, which is up 20%.
That divergence is just wild. Usually those two move somewhat in sync as proxies for the consumer.
Not this year.
But let's talk about why Amazon has been in the penalty box. It's this CapEx number. Amazon told Wall Street it plans to spend $200 billion on capital expenditures.
It was a complete sticker shock moment for the street.
Can we just pause on that number for a second? $200 billion. That's the GDP of a small country like Greece or New Zealand. It's a staggering amount of money.
It is an astronomical amount of money.
And the bears, the critics, they're looking at Amazon's free cash flow. The trailing 12-month free cash flow is sitting at about $11.2 billion.
Right.
So I'm not a mathematician, but you have $11 billion coming in and you want to spend $200 billion? That math looks pretty scary on the surface.
It does, and that's the bear case in a nutshell. They are calling it reckless. They are worried that Amazon is just burning cash to chase the AI dream, trying to catch up to Microsoft and OpenAI, and that there won't be any profit left for shareholders.
They see it as a black hole where capital goes to die. But, and here's where it gets really interesting, there is a very strong counter-argument emerging today. We've got a source here from G&G Research that frames this completely differently.
I love this take.
They aren't calling it a black hole. They're calling this the digital railroad moment.
This is such a great analogy. They compare this moment to 1869, the construction of the Transcontinental Railroad.
Okay, walk us through that, because 1869 feels like a long time ago.
Well, just think about the psychology. In 1869, if you were a critic, you looked at the cost of laying track across the Rocky Mountains and you said, this is insane.
Yeah.
The dynamite, the steel, the labor, it's a money pit. Who even lives in the Rockies? Why are we spending millions to go to California?
Right. It just looked like a bridge to nowhere, a giant expense with no clear return.
Exactly. If you looked at the balance sheet during the construction, it looked like a total disaster. But the visionaries, they didn't focus on the cost of the tracks. They focused on what would move on the tracks. They saw that once that infrastructure was built, it would unlock commerce for the next 100 years.
And that's what Amazon is doing.
That's the bull case. They aren't just maintaining old servers. This $200 billion isn't maintenance capex. It's not just fixing broken windows. It's growth capex.
So new stuff.
Brand new stuff. They are laying the fiber, they're buying the custom silicon, building the nuclear-powered data centers. They are building the digital railroad for the entire AI era.
So the argument is, if you believe AI is the future of commerce, then someone has to own the tracks. And Amazon wants to own them so they can charge a toll on everything that moves.
Precisely. And honestly, the numbers backing up the core business are actually pretty strong. It's not like the business is failing while they build this.
Right.
Look at AWS revenue in Q4. It was $35.6 billion. That's 24% growth. Still huge.
And the margins are insane on that.
35% operating income margin on that cloud business. That is $12.5 billion in profit just from AWS in one quarter. And their advertising business grew 22%.
So the core is still hunting.
The core is a cash-generating machine. And the bull argument is that the market is misclassifying this $200 billion. They are treating it as an expense that hurts the bottom line instead of an investment that builds the next monopoly.
It's a growth engine, not a black hole.
Exactly. And if you look at the intraday price action today, that bounce from red to green, it suggests that maybe, just maybe, the market is starting to wake up to this view.
Now, speaking of waking up, we had a listener write in with a very specific question about this. User at Free Roving Bovine sent us a message. Very concise. Just.
Short and sweet. I appreciate the brevity. To the point.
Gets right to it. So at Free Roving Bovine, we're going to answer you right now. First off, there is a specific catalyst we need to mention that supports this digital railroad thesis. We saw news today about an AWS and T-Mobile partnership.
This is key because it shows Amazon isn't just building the AI infrastructure for themselves. They are partnering to sell that connectivity. They are actively monetizing the pipes as they build them.
So taking all that into account, the intraday reversal, the partnership, the digital railroad thesis, what is the play here? What's the strategy?
Well, looking at the chart, that bounce off the lows around the $198, $199, and reclaiming that $201 level is technically pretty bullish. It shows buyers are stepping in with conviction.
Okay, so for our learner listeners, what's a strategy that takes advantage of this without just blindly buying the stock? Because let's be real, buying a stock right before earnings or in a market this volatile can feel a lot like gambling.
This is a perfect setup for what we call selling puts.
Okay, let's slow down and break that down. Selling puts. It sounds risky. It sounds complicated. I hear options, and I get nervous.
It's actually quite simple if you just change your perspective. Think of yourself as an insurance company.
Okay, I'm the insurer. I like that.
When you sell a put, you are writing an insurance policy for another investor. You are promising to buy Amazon stock from them at a certain price, that's the strike price, if it falls to that level by a certain date.
So let's say I pick a strike price of, I don't know, $215.
Yeah.
Just as an example.
You could, or maybe even lower to be safer, like the March $215. You're making a promise. If Amazon drops below $215 by the third Friday in March, I will buy it from you at $215 a share.
Okay, and why would I do that?
Because in exchange for making that promise, you get paid cash right now, today. That cash is called a premium.
So I get paid today just for promising to buy a stock that I actually like at a lower price.
Exactly. And here is why it works so well in this kind of market. Scenario A. The stock stays flat or goes up, like Amazon seems to be doing today. The option expires. You never have to buy the stock. But you keep the cash premium you were paid.
That's free money.
It's free money, and I like free money.
Me too. What about scenario B?
Scenario B. The stock drops below your strike price. You are obligated to buy the stock at $215. But here's the thing. You get to own Amazon, a stock you wanted anyway, and your effective cost is actually lower because you still keep that cash premium you were paid up front.
So I'm essentially getting paid to wait for a dip on a stock I want to own for the long term anyway.
That is the perfect way to look at it. And specifically for this setup, the volatility is high right now because of all this AI anxiety, which means the premiums are fat. They're juicy. You get paid more when the market is nervous.
Ah, so you're selling insurance when everyone is scared.
Precisely. It's a way to generate income while the stock stabilizes itself.
There you go. At Free Roving Bovine, keep your theta positive.
Theta, yes.
We have to explain theta. It sounds like a sci-fi villain or something.
It's not nearly as exciting. Theta is just the Greek term for time decay.
Okay.
Every single day that passes where the stock doesn't crash, the value of that option insurance policy you sold decays a little bit, and that decay turns directly into profit for you, the seller. It's the clock ticking in your favor.
I love having the clock on my side. But we have to do the standard disclaimer. there is risk.
Of course. If Amazon goes to zero for some reason, you still have to buy it at the strike price. So do not sell puts on a stock you wouldn't be happy owning for the next 10 years.
But given the digital railroad we just discussed, owning Amazon at a discount seems like a risk worth analyzing.
I would say so.
Indeed. Now, let's pivot. We talked about the real stuff winning. We talked about Amazon fighting back. But there is a sector that has just taken it on the chin today. Software.
The software wreck. That's a good name for it.
It is ugly out there. We have a report from Goldman Sachs, specifically from their strategist Ben Snyder, highlighting some pretty terrifying numbers.
It is a bloodbath in the software charts. The IGV, that's the ETF that tracks all the huge software stocks like Salesforce, Adobe, Microsoft, has plunged 24% in just the last 3 months.
24%.
That is a bear market and then some. It's a crash.
And the narrative driving this is just pure fear. It's the AI is taking our jobs narrative, isn't it?
That's the headline risk. The fear is that AI makes software cheaper, easier to code, and eventually makes software as a service companies totally obsolete.
The argument is, why pay for a seat on Salesforce if an AI agent can just do the work and build its own database for you?
Exactly. And we saw this panic play out in logistics stocks just yesterday, right?
Oh, that was a classic example of shoot first, ask questions later.
A report came out suggesting AI would disrupt logistics brokerage. And the entire sector, we're talking wealth managers, insurance brokers, logistics firms, sank 7% instantly. It was completely indiscriminate selling.
But then they bounced back the next day.
They did. But software hasn't bounced back yet. But here is the real stuff reality check on software. Ben Snyder at Goldman points out this massive disconnect, a huge divergence. While the price of software stocks has dropped 24%, the earnings estimates for the next 2 years have actually risen by 5%.
Wait, pause there. That is crucial. Let me make sure I'm hearing this right. The stock prices are crashing because everyone thinks the companies are doomed.
Correct.
But the analysts, the people whose entire job it is to check the books and model the future, are saying, actually, these guys are going to make more money than we thought.
Exactly. It is a massive divergence. Normally, when a stock crashes 24%, it's because earnings are collapsing. Here, earnings expectations are going up.
So what does that do to the valuation, the multiple?
It absolutely crushes the PE multiple, the price-to-earnings ratio. We've seen software PE ratios compress from around 35x, which is, expensive, to under 20x.
Wow.
That is historic value territory for this sector.
So we have what you'd call a lethal assumption at play here.
Yes. The lethal assumption kits both ways. The bulls assume, hey, earnings are fine, the price is down, this is a massive buying opportunity. Buy the dip.
And the bears?
The bears assume the earnings estimates are completely wrong. The analysts are blind. AI is going to destroy the entire business model in 3 years, so the E in PE is about to vanish.
It's the most dangerous part of the market right now.
Without a doubt.
It's either a value trap where you buy it and it just keeps going to zero, or it is the trade of the decade.
And honestly, we won't know the answer for a few quarters. It's a real cliffhanger. But the math, the actual numbers, suggest that the fear might be overblown. Goldman seems to think these stocks can find a bottom right here.
It's also worth noting the sentiment shift in chips, just to add to the tech confusion. We saw that SoftBank sold its entire NVIDIA stake.
Which definitely contributed to the get-out-of-chips mood earlier this morning. When a big player like SoftBank sells, people get nervous.
Of course. But then on the other side of that, you have George Soros doubling down on big tech.
Yeah.
So you have these titans of finance placing completely opposite bets.
Total confusion.
Which brings us back to the individual investor. If SoftBank is selling and Soros is buying, and Goldman says software is cheap but the market says it's dead, who do you trust?
You trust the cash flow, and you trust the real assets.
Which brings us to the forward-looking part of our deep dive. We have some serious earnings on the docket that will test these theories.
Tonight, Tuesday night, Palo Alto Networks, ticker PANW. This is huge for the software debate. Palo Alto is cybersecurity. The entire narrative has been that companies must spend on firewalls and security to protect their new AI data centers.
Right. If you are building the digital railroad, you need security guards? Lots of them.
Exactly. So if Palo Alto reports strong numbers and, more importantly, strong guidance, it validates the digital railroad thesis. It proves that the CapEx spending from Amazon and Google is flowing downstream to security vendors.
But if they miss?
If they miss, or if their guidance is weak, it confirms the software rec thesis that corporate IT spending is drying up and AI is sucking all the air out of the room.
So it's a binary outcome tonight.
Very much so. It's a major tell.
And speaking of medical tech, which we touched on with Masimo, Medtronic is also reporting tonight.
Right, connecting the dots. If Masimo is up on these consolidation rumors, we need to watch Medtronic. If they show strength in their core device business, it just adds more fuel to that real asset fire.
And then the main event, Thursday, Walmart.
The new member of the $1 trillion market cap club. It's incredible. And remember that divergence. Walmart is up 20% this year. Amazon is down 12%. That divergence is the story of 2026 so far.
It is. And Thursday is the ultimate consumer test. We had General Mills warn today. Their stock is down 3.3%. And what did they cite? Weak consumer sentiment.
So the maker of Cheerios and Cinnamon Toast Crunch is saying the consumer is weak. That feels bad.
It sounds bad, but it raises a really important question. Is the consumer too weak to buy name brand Cheerios? Or are they just trading down to Walmart's great value brands?
The trade down effect.
That's the key. If Walmart comes out and crushes earnings, it means the consumer is still spending, but they are hunting for value. That fits the soft landing narrative perfectly.
But if Walmart misses, if they come out and guide down.
If Walmart says, hey, even our shoppers are pulling back, then the soft landing narrative is in big, big trouble. Because if you aren't spending at Amazon and you aren't spending at Walmart, you aren't spending anywhere.
That is the fear. So Thursday is going to be a massive market mover. Absolutely. The whole market will pivot on that number.
So let's wrap this up. Let's bring it all home. What does it all mean for you listening right now?
The big takeaway, the one thing to remember, is that the market is rotating. It is moving from the abstract to the concrete. It's selling the dream of AI software and buying the infrastructure of reality, the ships, the power plants, the medical devices.
And Amazon sits right in the middle of that storm. Is that $200 billion a waste? Or is it the foundation of the next decade of growth? The market seems to be warming up to the digital railroad idea today.
And remember that option strategy we talked about. Volatility creates opportunity. Don't be afraid of it. Learn to use it.
Okay, so here's my final thought for you to chew on. We talked about software PE multiples crashing from 35 down to under 20, all while the earnings estimates are going up.
The great disconnect.
Right. Ben Snyder at Goldman thinks it's a huge opportunity. The market, the price action, thinks it's a death spiral.
It's the ultimate contrarian test.
Exactly.
Yeah.
So one of two things must be true. Either the analysts who do this for a living are completely blind to the coming AI apocalypse that's going to destroy software, or the market has just handed you a 24% discount on the future of productivity. Which side are you on?
That is the billion-dollar question.
Keep your theta positive and your assets real. We'll see you next time on The Deep Dive.